I'll just turn on the broadcast. Hi, everybody. I see people are starting to stream in. So just give us a couple minutes while we let people settle down. All right, thanks. Hi, everybody who just joined. While we're waiting for people to stream in, maybe a quick poll. I'm just curious where everybody is from. If you don't mind putting in the your chat group or the Q&A. And if you have questions, please feel free to start posting it in the Q&A, and we'll make sure to answer that. Yeah. All right. Hi, Jeff. Hi, Mike. Lots of people from Baltimore here. Hi, Kwang, Fernando. Hi, Tong. I hope everyone's having your nice dinner in front of you while you're listening to us. From Virginia. All right, Bucks County. All right, we've got a good mix of people here. DC, Philly in the house. Ken, good to see you. All right, we'll just start in 1 minute. All right. Aiden, what would be really, I've always thought of this when I do webinars. What happens if you see your mama suddenly logging in? You're on mute, by the way. Would you mute her?
I'd probably stay on mute myself.
You stay on mute. All right, guys. We've got a good crowd going. Thanks all for joining us. Again, feel free to ask your questions immediately. Don't wait for the end of the session. We'll try to answer your questions as quick as possible throughout the presentation. Hey, Seema, good to see you. All right, so we're 6:05. So I think let's start. Aydin, what do you think? Yeah.
I think so. Let's do it.
Yep. All right. Thank you all for spending your evening with us. I really appreciate your time today. So we have a really interesting session today, and hopefully it will bring you a lots of value. So we have been, obviously everyone's in this current situation, the COVID situation, working from home, lots of challenges and considerations I'm sure you have in your own household, as well as the concerns about the economy. So today we're going to be touching on quite a few topics, but primarily we're going to focus on, why multifamily investments, something that both myself and Aydin actively participate in, and why we think that is a good investment for you. And we'll talk a little bit about our upcoming investment in a project in Philadelphia. All right. So first, standard disclaimer, here, this is purely educational session. If you're interested to learn more, please contact myself or Aydin, and we'll be happy to share more details regarding the investment with you. So my name is Kelvin. It's good to meet all of you. I see quite a couple of familiar faces. So I'm a partner at GL Capital. I've been spending a lot of my time in the past few years investing in real estate in the US. And prior to that, I was based in Singapore, Shanghai, working for a private equity firm, doing something similar. So, it's been an interesting ride. Myself and my partners from GL Capital, we all met in business school, and, we started this company about in 2016. Aydin, you want to talk about yourself a little bit?
Sure. I run the acquisition arm for Ate Partners. It's a full service development firm in New York City, and we focus on multifamily investment and development in obviously New York, but as we'll get into later, B and C cities, which are more important now. I went to American University and then grad school at NYU, and currently live in NYC, although I fled the city 8 weeks ago, and I'm in suburban Philadelphia right now until things get till I'm allowed to go back to New York.
So it's interesting. The last time I met Aydin in person, we were at a basketball game in New York. So just a couple months ago, right? Crazy.
Packed house, shaking everyone's hand.
I even fist bumped some of the players. Lucky I'm all good. So a little bit, I touched this a little bit, for those of you that are not familiar with our platform at GL Capital. So here's a snapshot. We started in 2016. We're specialized in real estate investments. We've done primarily investing in multifamily, retail, some commercial, meaning like industrial property. So we're very active in Baltimore. That's where, our partners live, most of our staff live. But that has not stopped us from going outside of Baltimore. Part of that reason is we just wanted to diversify our number one investor base, but also our assets. Our investor base comes from, it's actually worldwide. In fact, I see some of our Asian investors online, some of our friends who are based in Asia. So at the bottom here is some of our press releases that we have, garnered in the past few years. We bought this really nice building in what we like to call our, what's that building in New York? The Iron Building, the one?
Flatiron.
Flatiron Building, right? That's the Baltimore's Flatiron Building, one of our favorite. We have done some innovative projects with the city using CPACE, and if you're interested in CPACE, we're happy to share more with you. And the right here is really our team, really diverse team. We all met at Hopkins, as I mentioned, and then we just really partner up to start this investment group. Here's a snapshot of our investment portfolio. As you can see, we're heavily tilted towards multifamily investments. All in, we have got about 200 active units currently. We're in the process of building the pipeline. As I mentioned today, we do have a live project where we're doing something with Aydin in Baltimore as well, which Aydin can talk a little bit about later, and we'll have a subsequent webinar. So overall, our growth has been, not bad. Maybe this COVID situation might put us back a little bit, but we think there will be really nice assets for us to acquire. we like to pride ourselves as not just an investment firm. We're very active on, in the speaker circuit. We try to get our message out that it's not just about real estate investments. It's not just about the, delivering shareholder returns, which is really important, but also how do we be engaged, right? So I'm part of some of these forums at the bottom left. I'm part of this group, CRE Connect Summit. Fortunately, we had to postpone this, but we have been inviting a lot of people from DMV to come participate, and how do we figure out and make sure this community is better. Again, this is an example of a snapshot of our live events. We hope to be able to do more of them as soon as COVID, subsides. But rest assured that we are, heavily involved in the community. We like to get our message out. We would like to help people just realize, some of their investment goals, as well as how do we make real estate, part of the community. And this is one slide I want to mention also. So as part of the COVID situation, we've been monitoring quite closely. We took a really active stance towards it. We monitored what was happening in Asia. And, when the situation in, the US started to become, more serious, we started sourcing from our Chinese partners, some of the PPE required. So to date, we have, I think we donated quite a lot of masks, gowns, gloves to local hospitals. So you can see some of the pictures that we did, actually the picture in the middle is actually of Johns Hopkins. That's where our team actually delivered critical mask supply to them. So if you're interested in supporting our fundraising drive, please go to that website, and we'll share it. Maybe one of my team members can share it on the chat group here. We'll post it after the webinar as well. Aydin, you want to talk a little bit about Ate?
Sure. So Ate Partners, like I said, we're based in New York City, vertically integrated, meaning under Ate Partners, there's Ate Architecture, there's Ate Construction. We rely heavily on self-performance. And as I mentioned, I run the acquisition arm. So for me, my job is pretty easy in that I can find a deal, and the guys who are running the architecture and construction side can efficiently and effectively design and build it for me. And we can build out our portfolio, which is what we've been doing. So Ate Partners has been around for 2.5 years. Ate Architecture and Construction much longer, but collectively we've come together and we started focusing on our backyard, Brooklyn. You can see there's a couple properties there. The renderings, of course, that we're building currently in Brooklyn. But as we started building in Brooklyn, we realized there are other cities that multifamily will, it's better suited for, and it's easier to build, such as Philadelphia and Baltimore. We can get into those later. You can see some of our select transactions there. A lot of it was actually on the hospitality and retail side. So the full spectrum of design and construction can be accomplished under our umbrella. But we're focusing our current portfolio on multifamily and to a lesser extent mixed use in secondary and tertiary markets. We can go to the next slide. You can just see a little more about who we are, our approach, regional focus, general transaction size, and specifically in Baltimore, we've also partnered up with Kelvin and the GL team in one development that we'll discuss later, but one property in the Mount Vernon area where GL is actually our property manager. And we can get into that, Kelvin, whenever you think is fit.
Thanks, Aydin. So for many of you that are curious about, our partnership with the Ate Group and Aydin. So, as Aydin mentioned, we started off with, one of the projects that they had in Baltimore, and Aydin's group has really been really great to work with, really strong partners. So I think we wanted to extend that cooperation. We're doing more now. We see a lot of similarities and, of the way we approach investments. And, with them on board, and we're going to talk a little bit about our value add strategy here on this property. But we think that they be excellent partners. So if you have any questions regarding our property, about our group, please also approach Aidin or myself. So coming back to the theme of this webinar, so why multifamily investments, right? So I'm just going to show you some stats. Right, here's a recent stat. This was published just in April. Now, this is a poll that basically ranked real estate, stocks, savings account, and gold, right? So what you've seen here over the past few years is that real estate has consistently been one of the top performing or something that Americans put as the best long-term investment. And we obviously are, believe in this strongly, because when you do investments in real estate, not only do you actually own a hard asset, right? But we think that if you invest well in a specific asset class within the real estate industry, that you're going to do well. We're going to talk about how we're going to handle COVID situation, but by and large, among the asset classes, we think multifamily is especially strong. Obviously, you've heard a lot about hotel investments being affected, and we can touch a little bit about that if you're interested. But by and large, I think this has been a really consistent message, right? So we also started a group and trying to help investors. How do we get exposure to real estate? Even if you have, limited funds, you can always start. And there are some ways you can do so with us. And as you scale your investment and you get more comfortable with it, that you can expand it, right? Here's another, example of why people are investing in real estate. So if you look across the 4 asset classes in terms of real estate, your equity, bonds, and bills, and this dates back all the way to 1890, right? We've seen that in real estate has consistently delivered, more than in excess of 8%, right? So we think that this is a strong asset class itself. And obviously you're not as exposed to, the market conditions. You can't really mark to market every single day, unlike the stock market. But so the type of investors that usually come in are looking for more consistent, dividend type of returns with a big capital appreciation at the end after you sell the property. So again, another reason why we like real estate is generally been more stable, right? I talked a little bit about this with stock market. Yeah, in great times, you can do very, very well in stock market, but real estate is more consistent, kind of like a dividend play for you, right? So the big question for us, a lot of people are probably wondering why, why multifamily, why now, especially in this situation, right? So let's talk about the shape of the recovery, right? So here's a chart from JP Morgan, right? It talks about from 1990, this tracks the number of news stories that are mentioned about U or V, right? So if you look at, some of the recession crisis, you will see that a lot of the news media particularly play up that they want to all do, the story count on V recovery is very high. I think for most people, this is quite understandable, right? Obviously, everybody wants a sharp uptick immediately after a crisis happens, but we think it's not so simple, right? Obviously, JP Morgan is biased. They do really well in bad times and with distressed assets, but in good times, especially the M&A volume goes really up. But what you don't see here is talk about other shapes of recovery, right? You've got people are talking about a W shape, an L shape, and the reality is no one really knows, right? So a question for all you guys, put in the chat group, just curious, what do you guys think the shape of the recovery will be? And how long do you think we will need to get out of this, downturn, right? Please send in your all right, with some W shape. Let's see if you can come up with any other interesting shapes, people, right? So keep them coming. Think, oh, wow, it's an @ sign. That means you go around in circles. We definitely don't want that, right? Right, great. Thank you guys for your participation. Keep them coming. Just curious to see what you guys all think. And Aidin, feel free to chime in and comment on the chat if you want. Okay, great. 9 months, 2 years. So really varied responses. Interesting. And we'll come back to this shape of the recovery shortly. But it's interesting to see everyone's perspective depending on where you are. Yeah, okay, let's move on to the next slide while we continue getting some of the responses. Now here is an interesting, really interesting chart, right? So where are the key markets where jobs are at risk, right? On the left, you see top 10 markets where employment is most at risk. I think Las Vegas, most people would probably understand it, right? Because a lot of the workers there, casinos being shut, tourism has been affected very, very heavily, and similarly, some of the other markets on the left listed here. But I want us to focus on the right. So at this bottom 10 markets where the percentage of jobs is at risk, you see here we highlighted some of the markets that we are invested in and also very active. You see Philadelphia is at 27%, and today we're going to expand more about Philly. IDIN is in New York. We are also looking at properties in DC. Aydin, do you have any comments on New York? And what's your take on New York market?
New York, it bounces back pretty quickly. People want to live in New York. From a multifamily perspective, the people I speak to, obviously New York has also a lot of luxury condos, and that has been over the last few years taking a hit. People are buying less, they're renting more. I think that's more of a national trend in that people are just more mobile. And, our parents' generation was all about buying a house and setting up roots and living in that house for 30, 40 years, like, my parents are. And when I tell them, no, we could be anywhere at any time, you got to stay mobile, like, people aren't saving as much. And if they are saving, they don't want to put it into a down payment. So the rental market in these larger cities, like New York, Boston, San Francisco, DC, Philly, as long as the jobs are there, people are going to be renting. So yeah, New York may take a hit, just like the rest of the country will because of coronavirus and people losing their jobs. But as people start gaining their jobs again, New York is still going to be New York, and people are going to come back, and the rental market is going to keep going up. Because in this short amount of time, people are not going to be able to save the significant down payments to buy the high end or the more expensive condos.
Right. Thanks, Aydin. So got interesting comment. So instead of investing in real estate, why don't you guys invest in hand sanitizers? Interesting. Maybe gloves too, right? Maybe we should have a separate webinar on that. Investing in hand sanitizers and PPE equipment. So the big question on everybody's mind, especially people, if you're renting, you probably you probably know somebody that's got affected, right? So your big question on your mind would be, what are collections like? So here's a recent survey by the National Multifamily Housing Council. Actually, April was not too bad, and we see this reflected in our own portfolio as well. There have been tenants that have indicated to us that they have lost a job and they're asking for some reprieve from it. So there are several methods and proactive strategies that we've done, and I'll share with you later. But by and large, our experience, our personal experience with our portfolio is this number is pretty accurate within our portfolio. Of course, it differs from within the real estate class. Obviously, for retail, it's going to be much more affected. But this is a multifamily survey, and we think it mirrors very well with what we're seeing on the ground, right? If you look at more data here, rent collection has been quite resilient, right? You see in April 2020, it's about 91.5%. So the big question on everybody's mind is, what does May look like? And May's rent has come in. We see it pretty stable, at least within our portfolio. And this is really a function of how well the property manager communicates with the tenants, what kind of product type it is, and we'll dive into that later. And you have specific questions on, our portfolio, please share it on your Q&A, right? We'll be happy to answer them. So what are the measures we've taken so far, within our portfolio? There are four main things that we've done so far. What we really want to do is over-communicate with our tenants, also communicating with our banks, right? So, at least within our residents, once we heard of the COVID situation, we have been actually sending out reminders on them about how to stay healthy, We are making provisions for them, in terms of, like if you have a economic situation facing you, please inform us early. We'll set up payment plans. And most of them have actually been very, very appreciative of what we're doing. So and also on the attracting new tenant side, we have actually adopted, especially for a lot of the new units that came up for lease, our team has been working really hard to do virtual tours. In the past, our experience was that we tried to shift a lot of people into virtual tours, but it wasn't that effective, right? People just like to see the units themselves. But now increasingly, probably it's a new normal. A lot of people are starting to get comfortable with video walkthroughs, right? Some of them are, a video walkthrough that we've done prior to them even showing interest. Some of them prefer a live walkthrough. So our property managers have been working hard, taking them, just a FaceTime video, just walking them through the unit. And then on the third, there's a lot of, people crave social connection, right? So to our end, we have tried to organize, some virtual meets for our tenants. Some of them prefer to talk, face to face, in terms of through a Zoom with our property managers, just to give them some, confidence that this crisis will pass. And then the last one is we try to garner a lot of reviews from our tenants, right? And it shows quite obviously. If you do a search on a lot of property managers, I'm sure when you do a quick Google search, you get quick reviews. So this is a great time to show as property managers, as landlords, that we care. And just based on our experience so far, it's been working. So stay proactive, and I think the tenants will appreciate it, and they'll be long-time tenants. So how should you respond? We talked about, the shape of the recovery. So I just want to leave you with this, right? So I think the most important thing, regardless of what the recovery will be, no one really knows how long it will be, right? So I think for, kind of the thing I coined was, as long as we stay united, right? Let's not, let's stay united, right? We can come out of this together. We'll come out victorious. We'll be winners at the end of it. And more importantly, L, right? L, people say it's a depression, but these icons here really demonstrate how adaptable, human beings are. Even working from home, you've probably seen a lot of clips where people are rock climbing, for example, rock climbing in the kitchen from their granite countertops. They're skiing on the floor, pretending they're skiing. I don't know how people do it, but it's worth. If you go YouTube, you can check it. And look at Aydin. He even has a basketball ring at the back. I'm sure you've been playing, Aydin.
Yeah. Every time I have a bad idea, I crumple up the paper and I just bounce it in. It went in. I don't know if you saw.
It went in. Okay, I'm sure it did.
The Zoom camera's a little off.
Right. So guys, people on the panel and as well as attendees, I would urge all of you to stay positive, right? This will pass, right? So let's stay united. We'll get, figure out interesting ways. We will be happy to do more webinars with you if you like, varying topics. But yeah, that's my main message to you. But now we want to move into this deal that we're working on. This is a off-campus student housing deal that we're investing in. It's 27 units, very near Temple University. Just some snapshot of this building. Built in 2005. Really beautiful building. In fact, when we toured it a couple times, it's so near Temple University that it's just amazing. I think that we will have a really good rental rates once things pick up, right? So just some quick snapshot of the deal mechanics. We anticipate a 10% average cash yield, 29% rate of return, and we're negotiating a bridge loan that we will do value add upgrades that Aydin will talk about later. So we think this is a really, really strong deal. We're still finalizing some of the CapEx numbers, renovation numbers, but by and large, I think we're probably ranging between 500 to 800,000. And for anyone's interested, we'll send a more detailed model to you. So some highlights, as I mentioned, very, very near Temple University. Literally right across the property is campus security. So it's also a very secure environment. Our strategy is a value add. We'll be going in, turning around some of the units, making it modernized. It will increase our rents. quite significantly and would be able to deliver a good return. So this is our strategy, right? I think about 33% of the units have not gone, that needs to be remodeled. We may do even more, depending on what Aideen's team will come up with. And we have a lot of confidence in their team to be able to deliver a fantastic product. We're going to improve the management. There's some practices that we think that could be heavily improved with our active management strategy. We also are talking to a local property management company there that has a sizable number of properties in their region. So they're highly specialized and we'll probably be working very closely with them. Currently, there are no water and gas fees that are being charged, so we intend to do that. And also improve the marketing and overall leasing strategy based on what we have learned based on our own portfolio. So this is where the property is located. As I said, literally 1 block away from the center. And we see a great amount of traffic there. We think this area is fantastic, right? Here's some pictures of the current lobby. This will look very, very different when Aute Partners comes in, and Aideen will share more about that. Here's some of the sample layout, very comfortable, spacious settings, right? This is the living room and kitchen. As you can see, some of the finishings are, not bad, but we think that the unit can really pop with, our partners' help, right? And that's what will distinguish our property from some of the newer product that has come online. So these are large spacious rooms without the furniture, and there's a lot of potential to modernize the finishing, especially in the kitchen areas, some of the rooms, and the bathroom, obviously a very important part of your house. Currently, it just looks something to be desired, and we'll make a lot of changes to it. So Aideen, you want to talk about some of the things that your team has come up with?
Sure. So this just shows the array of what the design and construction team at Aute has done in the past. Some of these are from high-end condos and apartments. Some are from just rentals to just basic rentals. And I can't tell the difference, but you can tell from an aesthetic look. You can obviously make a space look as nice as you want it to if you have the skilled craftsmen do it. So our idea for this project is generally, we specialize in taking a building, maybe a Class C building, and renovating it completely, whether that involves ripping it apart down to the studs and just rebuilding, or just doing cosmetic finishes, or a combination of both. This particular building, I think it's in pretty good shape. I mean, we've done all the diligence in terms of structural reports. The bones are pretty good, as they say. What the architectural and construction team have come up with is not a heavy lift, but I would say a normal size lift that allows the building to transition from, you don't want it to look like a dorm room, right? You want it to look like an apartment, even though it may be students mainly that are renting this. And Kelvin, correct me if I'm wrong what your vision is, but look, you don't want it to be like a dorm room. They don't want to have to worry about like an RA coming in because they're playing their music too loud. So you take that look that's there now, and you change the aesthetic to look a little more modern, a little more hip, and a little more in tune with the aesthetic that A, the neighborhood has, and B, the tenant, the clientele will want. So with that said, I mean, without knowing what the final finishes that will be chosen are, that's generally what's going to be done. So if you can see the second picture from the left, that's just tile work. That's very fancy tile work. And you can turn any bathroom into that if you have the right skilled craftsmen to do it. So you can take, and I don't know, Kelvin, if you can go back to like what a picture of a bathroom in this unit looks like.
Yep. Here's, yep.
Yeah, so that's, I mean, that's not difficult to turn into just, you just prep it and add tile. Like this is a very barren bathroom, but you can change certain things like the vanities and the fixtures and the tiling, and you can turn it into, if you go back to the next slide, Kelvin.
Yep.
You can make it look like that. So with that said, I think every room will be looked at in that manner, and the common areas as well. You don't have to do too much. You keep it simple, and less is always more when it comes to finishes and changes. Because the rooms are spacious. It's larger than most rooms that I've seen in this type of asset class. So I think that's what we're going to do from a cosmetic standpoint, because there's not much else to do in terms of mechanical or anything of that nature.
Yep. Thanks, Aidin. Yep. So we're going to be really excited to see your team's, drawings, and I'm sure it look beautiful. So let's move on. So a little bit more about the neighborhood. So I think most people, seeing that majority of you guys are from the DMV region would know this pretty well, right? Philadelphia, one of the great cities in the US. And we got a partner, like Andrew on our team is from that area. So we have very good comfort in dealing with, the neighborhood, the city itself. It's not far from where we are based in Baltimore. Aidin and his team are based in New York. It kind of meets in the middle. So we like this area a lot, and we see tremendous potential, especially once this thing subsides. And even if COVID situation, as I mentioned earlier, I think Philadelphia will be somewhat stable, right? Because the percentage of people exposed to some of the more service-orientated businesses are not really in Philly, right? So just a bigger picture of where we are located. You see in the middle in the picture here, it's where Temple University is. That square, the dotted square there, is what has been designated as the Temple University area. So, Temple is a big university. We think housing is going to be strong there. There's, a lack of, actually, the university is planning to build more student housing because there isn't enough. So that leaves us a lot of room to be a provider of a good housing option. Here's an example of what they have on campus right now. Quite a lot of beds, they have 5,600 on-campus student purpose beds. There's definitely room for a lot more. And some of the product are a little bit dated. So we can distinguish ourselves, by offering a much newer, modern product, right? Here's the off-campus housing product. You see some of the product is much newer, right? So we're competing against those. But the difference here between Sydenham and some of the newer Class A buildings is the Class A, much more expensive. They have a lot of facilities, yes. So we're not directly competing with them. Instead, we're offering a really nice B+, close to A product. Facilities will be nice. Will be the finishing. More importantly, for students, especially, you're just spending most of your time, in your room, when you come back from school. So we think that is the most important. Facilities are a plus, but not necessary in terms of our business strategy for this deal. So I'll give you some examples of rent comps, right? You see some of the star ones are the ones that we picked out that are closer to Sydenham's style of property, right? So among that, within that vicinity, we have done a few. We have done some rent analysis, and here's a more detailed breakdown, right? We've broken it down by some of the different types of product here. As you can see, you will zoom in on the average price of per bed. It's about $1,300 for a 1-bedroom on average, and the 2-bedroom is about $1,900. So we're coming in close to that. I think that we could probably get a higher pop because it's a modern product, but for all our properties, always we have never priced ourselves, like very high, comparative to market. And this is a deliberate strategy because coming from, I was just an MBA student, international student about 5 years ago when I came to the US. Some of my partners as well. We have very first-hand experience of, renting, right? So we understand the pains of some students, some of young professionals. You want good quality housing and you don't want to pay too much for it because you're at a stage where you're kind of building your income. What's most important is the environment is safe, it's comfortable, and you can be proud of, right? And that's what we aim to deliver. So snapshot of a finance, this is a really heavy slide. And we're happy to share it with the attendees here if you indicate in the chat group that you're interested to learn more, and we'll send this out later. But here's our kind of projections, right? So I think by and large, this kind of mirrors what we're seeing within our own portfolio. This is subject to some revisions, but by and large, we think the first year, our business strategy here is to keep, as many of the units leased up as possible. We'll free up some of the units so that, the IDIN and AUTE partners can start doing the renovation. So that will we'll do it in phases so that we constantly try to keep the property leased, and so we can. And the bank debt that we're getting is a bridge loan, which means to say that, we'll try to focus as much as possible to complete the construction ASAP, right? And then we get it refi. That's where you see a big pop in year 2 in 2021. Now, obviously, COVID situation might change this calculation a little bit, but we're monitoring the situation very closely, including watching what Temple University is doing. But I don't want us to walk away with the idea that this property is solely for students, because with the great location, even staff or even young professionals living in the area, we think that this product will be very, very suitable for them. So students, young professionals, the crowd really, we're agnostic, almost agnostic towards the population that lives in the property. Regardless of what the student, what the population of the property will be, I think the message is the same. We want to deliver a very nice product for people, right? This is some of the estimated investor returns. You can see this reflected in year 1. We anticipate, to preserve as much cash as possible because we'll be spending quite a fair amount on the renovation. Here's year 2 is where you see the big pop after the refinance, right? We'll be able to see much more stable returns after year 2, and that's where we distribute quarterly dividends to our investors, right? Again, I'll share with you for interested parties on this detailed slide, right? Oh, so yeah, so I think we've come to the Q&A section. So we've left both myself and Ideen's contact information. For those of you who want to use QR code to scan, please go ahead. We have our QR WeChat group there. You're welcome to join it. So I think Ideen, now we're in Q&A. So guys, please feel free to ask your questions. We're happy to take any kind of question that you may have. We have about 15 to 20 minutes. We want to answer as much questions as possible. So let's see, let's take from the bottom. How many students versus housing beds? So let me go to that slide first. And Ideen, you can scroll through the Q&A if you see anything you want to take on. Right. Right, so here's the number of students, Howell. Yeah, your question. So there are a total enrollment of about 40,000 students, all right? In terms of staff, we've got 5,900 on a full-time basis in Temple. It's pretty large population, whereas there's only 5,600 on-campus student housing, right? And then right here at the top, 5,600. And generally the kind of percentages, most universities have about 30% of their student population, being accounted for in terms of student housing. And the rest, once you're a graduate student or you pass the first or second year, you usually go for off-campus housing. And that's where we come in, right? Aiden, you want to take any question?
Well, here's a good one. Is the Temple project open for LP investment, Kelvin? Is it?
Yeah, it is.
Alec, I'm glad you asked that.
Yeah, yes, it is. Please, Alec, please, my team will reach out to you and we'll share with you more detailed information. Or if you have some specific investment questions, we're happy to take it right now. Do you think Philly or Baltimore is a stronger multifamily investment market? I didn't. Well, you go first.
Boy, that my biases might come out. Well, we're doing deals in both, so I think they're both great. But just to maybe, when AUTE looks at investment, you generally want to look at, and everybody has different investment criteria. We look for cities that are, take out New York, Boston, San Francisco. Think of, the second and third tier even city. you need people who make enough money to be able to pay the rent regularly for the products that we build. So think of cities that have a strong college and university network, a strong hospital network, and an interesting wrinkle that I like to look at is if that city has a professional sports team or not. There are factors that, and I know my teammates have heard me say this 1,000 times, that those three boxes, when checked, generally lead to a higher median income and a more quality, career-focused tenant that can regularly pay higher rents for nicer product. So I think both Philadelphia and Baltimore have those boxes checked. So it's not a matter of stronger, in my opinion. I think Baltimore probably feels less of the high. They feel less of the highs and less of the lows. So it's a little steadier market, whereas Philly may catch more of the upside, but also feels more of the downside in a situation like we have now. And I don't know, Kelvin, if you think what your thoughts are there.
No, yeah, I'm on a similar page. Obviously, you know, most of our portfolios in Baltimore as well. But obviously, within any city, right? If you just look at the high level numbers, it's very hard for you to get a firm picture of what's really happening in the real estate, because you know real estate is very, you know, it's very local, right? Depending where you select the asset, even within the same block, it could really differ on your performance. And this is where we come back to the core of what we're doing. You know, we're delivering a really good housing product at affordable prices, right? I think that is a principle that we will not divert away from. And we try to layer that on with, you know, good property management. As I mentioned, you know, most of my team here has experience. We were all students, you know, we had experienced what a bad landlord is, what a bad property manager is. So we want to change that. You know, we think that regardless of, you know, your age group, or, you know, it doesn't matter. You deserve good housing, right? And that's something that, you know, is really core to our company. And how do we deliver that? You know, we try to partner with good people. We keep the cost low. You know, we are highly attuned to, you know, expenses. We try to hire the best people. We get repair and maintenance men that are really responsible, right? So a couple more questions. How do you mitigate another pandemic occurring in the future? Thank you for the question. So actually, you know, I think the way I approach this is, I mean, real estate, to be honest, is quite a simple, you know, operation-wise, it's not that difficult on the macro level. It's quite simple, you know, compared with the number of variables you have to consider running a business, right? For example, if you're running a restaurant business, the amount of variables is so high. For us, priority is how do we get tenants in and secure them for the long term. We don't want too much turnover because that incurs costs. We have to, you know, spend for cleaning. You know, sometimes there are damages on the property. But another way, you know, that we approach this is, you know, insurance is really key, right? So in fact, there are some very interesting product from, for example, a company called Pensio. You know, they have a really interesting product which protects some of the tenants from job losses, right? So that kind of gives us and the tenant some protection. For the tenant, it gives them protection. Even if they lose their job, they can still pay the rent. They're not going to be, you know, facing too much stress. For our landlord, it gives us certainty of cash flow, right? So that's one. And in terms of, you know, how do we mitigate against a pandemic? I think a pandemic really, I think we're uncharted territory. I think what we have to focus on really, as I mentioned, whether is it regardless U, V, W, S, L, I don't know what kind of shape recovery, focus on ourselves. You know, we got to adapt. You know, we got to continue living. Everyone needs a place to live. You know, I think that, you know, as long as you deliver a good product, people will continue staying in, especially for real estate. Yeah. Let's see, what other questions? I think I saw some above. All right, couple questions on, you know, why can't we do live tours? I think, you know, this is really a management decision for us, for the protection of our employees, right? In fact, some of our leasing staff, they actually wear, well, they don't go to the extent of wearing a gown to do a showing. I think that would scare some people off, but at least they are wearing protective gear. They are wearing their mask, they're wearing gloves, using lots of hand sanitizer. So for the protection of our employees, number one. Number two, also protection of the future tenants, right? So we want to give them to ensure that, you know, they feel comfortable just touring the building. And I think we've managed that quite well. And I think if we can move to virtual, why not? I think it saves a lot of time. The technology has really improved significantly. In fact, for this property, we plan to do 3D tours. So that anyone, even before they come, you know, to visit, they have a sense of the property. And we've seen some great success. Some people have actually started signing up leases even before they toured in person, right? So this goes to the, you know, credit to the technology. Number two, also the credibility of the property managers, because I think you can, in this day and age, you can quickly, you know, determine what kind of reviews are being written about the property manager. I didn't.
And let me just step in there with GL managing our properties in Baltimore. April and May, we had 100% payment. And I think that's a testament to early communication to tenants to drive the fact that, look, something's going to happen. If you need help, please let us know. But to your point, also, Kelvin, about going virtual and the technology, and I think in the last 8 weeks, we've all realized that a lot of stuff that a lot of companies that we work for that pay a lot of money to be in big office buildings in big cities, a lot of that can be done from an attic playroom with a basketball hoop. Like, a lot of it can be done from just here. And I think that's what's going to drive multifamily and keep it strong. Like, office is obviously going to go down. I think it'll probably be creative and find its way back. Retail's always been topsy-turvy, at least in New York it has been. Hospitality, a lot of it's going to rely on how soon we can travel again and how comfortable people feel to travel again soon. But multifamily, if your home is your office also, you're going to do everything you can to make sure you stay there and make it your home. So I think missed rents and defaults will probably go down. I think multifamily in cities like Philly and Baltimore are going to do well in the long run, because people are going to realize, I no longer need to live in New York City because I'm no longer going into an office in New York City. I can live somewhere that's a little bit cheaper and get a nicer product. And I think that bodes well for investors and developers like Kelvin and GL and Ate and myself, investing and developing in these markets.
Thanks, Adrian. So you know what? I'm curious. I don't really see this being done in webinars, but if you would like to have some airtime, raise your hand. You know, we'll unmute you. You know, let's get some interaction here from the attendees. So if you're interested to say a few words, you know, we'd love to hear your comments. Just raise your hand, and I'll, you know, I think there's a function here where it can allow you to talk. Oh, this is amazing power that Zoom has given us. The power to mute and unmute people. Let's see, a couple more questions. Oh, valuation, right. That's a really important question. So valuation in this, I'll talk about valuation for this deal versus what we're seeing in the market. So without a doubt, I think there's been some pressure on the valuation of new properties that we're seeing being marketed. Now, this property we had under contract for about a month plus, maybe slightly more than that. So where we started off at a higher number. In fact, we got it under contract for about 4.4 million. We had recently gotten a reduction of about 400,000, so it's now at 4 million for the purchase of the property. And you know, part of that is, you know, some of the due diligence findings. Some of that is due to market conditions. So I think we are constantly engaging with the owner. I think what everybody wants to do here is just get a fair valuation for pricing in the risk. So we are very, very mindful of that. That's for this property. Overall, and I just speak for Baltimore market, right? I think the single family market especially is being affected quite a fair bit. For the multifamily so far, we are still seeing a good deal flow. Whether or not the seller really comes up, whether they're under pressure right now to sell, I think it's a little bit too early in the game. I think if you look at the uncertainty in the market, I think everyone's kind of wait and hold pattern. But we do see and we do anticipate valuation numbers coming down, especially for hotel investments, especially for office markets, because the nature of work might change, quite fundamentally after this, right? But multifamily so far pretty resilient. We are seeing some cheaper assets on the market, but nothing to shout about right now. So we have always stayed really disciplined in the way we underwrite deals. So we anticipate that to continue. Yeah.
And to that point, Kishan asks, great question, Kishan. No fire sales. I haven't seen any. I've seen some properties I've been tracking for 6 months or so pre-COVID, where the prices were just unreasonably high, and those sellers are more open to conversations in the number range that I had initially offered. So no fire sales yet, but I do see asset prices trending a little down depending on the seller. But again, like Kelvin said, I think it's a little too early to jump on anything at a huge discount.
Keep the questions coming, guys. We've got about 5 more minutes, so try to keep your questions coming. If we can get to them in time, we'll answer you after the webinar. All right, so we've got a question on Philly economic drivers. I think I'm going to hand that to one of my partners, Andrew, who grew up in that area. Andrew, are you there?
Hey, Kelvin, can you hear me?
Yes. So we've got a question, Andrew, from one of the attendees here.
Sure.
What are you seeing in terms of economic drivers? And I'm just going to that slide there.
Sure. Yeah. I mean, the two biggest industries Philadelphia is known for, they call it eds and meds. So those are the university systems, University of Pennsylvania, Drexel University, Temple University, all in the center city area, and then a number of other ones in the region. And meds. So that's pharmaceutical companies, life sciences, biotech, medical devices. DC and the NIH is a big eds and meds driver. Baltimore happens to be the other big city for that, but its proximity to New York and that DC area makes it a really good location for those big companies that are employing a lot of people. They also have Fortune 500 companies such as Comcast, a huge employer that's very Philadelphia based. There's food and culture that's attracting a lot of young people. Museums, obviously the Rocky culture and the Museum of Art. There's great neighborhoods, very historic neighborhoods of Center City, Fairmont, Northern Liberties, Rittenhouse Square. And it's really got the best sports teams in the whole country. The Philadelphia Eagles, the Flyers, the Phillies, and the Sixers. So for a variety of reasons, it's a great place to live, but it's also got these really incredible companies and universities that are bringing people in.
Thank you, Andrew. Thank you. More questions here. So given the current market disruption, when do you think will be the time to strike on new acquisitions? I think Aydin kind of covered that. You want to elaborate a little bit more, Aydin?
Well, I don't want to let you guys know because I want to buy everything.
We're doing it together, Aydin. You can't run away.
When's the right time to strike? I think it depends how long. I think overall asset prices will be coming down. That's just going to be a trend because the majority of maybe not the majority, but a lot of people have had their incomes affected in one way or another. And until that stabilizes again, however long that may be, I think asset prices will creep down. Obviously in areas that feel it more, I think like the Miamis and the Las Vegases and the Houstons. Well, Houston, especially with energy prices all over the place, I think asset prices will go down. Will sellers be, will they want to sell or will they want to wait? That's the question. And I think it's going to be different city by city. And I think that's when you need to know a city or know brokers in a city or have boots on the ground somewhere and you can really find value. I think it's going to be different in every region, especially with the country opening up in on a different timeline.
Yes. Yeah, I think we're seeing the same thing as well. We're constantly on the lookout for deals. I just don't feel that, there's particularly a sharp spike. I think people are just wait and see most of the time. Let's see. All right. Actually, I want to dial back a little. I did a quick poll earlier about the shape of the recovery. Just want to give the everyone online just a sense of the responses. The most optimistic one, 6 months recovery, V-shape. We had a lot of W's actually, and the W's range from, it's about 9 to 12 months for some of the responses. And the most pessimistic view is a U-shape, 3 to 4 years. Interesting. I certainly hope, I think it's also a function of how quickly the vaccine comes online. You've already seen a lot of Asian economies that are starting to open up. And frankly, it's my opinion that I don't think the government can continuously give stimulus. I think there's only so much they can do. So I think there has to be a phased approach to opening up, which means to say that if there's no vaccine, people are going to just have to get used to wearing masks, hand sanitizers, practicing social distancing. So things are going to change, but I think as I mentioned, we're going to be able to adapt, right? And I'm sure, let's all stay positive that everybody will come up well out of this. All right, so I think we're almost at 7. All right, so if we don't have any further questions, Aidin, any closing comments? You want to see how people can get in touch with you or learn more about Ate?
If you go to the slide with my email, feel free to email me, visit our website, which is currently under construction, but you'll get a general idea of who we are. And Andrew just put my LinkedIn on, so feel free to connect. This is, the new normal. We're working from home. So I'd love to talk to all of you about whatever deals you're working on and tell you about what we're working on.
Yep, thank you, Aidin. So, and from me, I think, thank you everybody for joining. It's been a really good session. Hopefully you found some value in this. Please let us know if you're interested to learn more about, real estate, economy, just any questions. We hold webinars regularly. In fact, I think next week, Aidin and I, we're gonna do another series. We're gonna talk about their deal in Baltimore. You wanna do a quick, just since we have people online, you want a quick 2 lines, 3 lines on what the deal is about, Aidin?
Absolutely. We are taking 6 contiguous buildings near Hopkins, and we're gutting the interior completely, renovating them to 18 multifamily rental units. There's a parking lot in the back. And we are currently raising LP equity. If anyone's interested in diversifying their portfolio into Philly and Baltimore, please let me know. But we can talk more about it next week. And Kelvin, GL team, thank you for having me.
Yep, thank you, Aidin. Thanks, Ate team. So lastly, if you're interested in learning more about this investment, let us know. If you're interested in being an LP, please feel free to reach out to me directly, email me, email Aidin, and stay safe, everybody. Thank you very much for your time today. Have a good evening.
Yeah, have a good evening, guys. Take care.
Hold on.